how do capital gains and or capital losses apply in reality? Let me give you a couple of examples, and this first one is going to be in a brokerage account. So in a simple taxable brokerage account, that's where this example is going to take place. So let me read this for you. So let's say you own a stock in a brokerage account, and you hold the stock for 18 months, and then you sell the stock. Okay? You will pay capital gains taxes. Okay? You notice I said capital gains taxes, not your income tax rate, on the gain that you made on that investment for the tax year in which you sold it. Okay? But then let's also say you were to have held this stock for 6 months and then sold it. Well, then you will pay your ordinary income tax, not the capital gains tax rate, your ordinary income tax rate on the gain that you made on that investment for the tax year in which you sold. So you can see, based on the length, as I said earlier, short-term versus long-term capital gains, right? You notice with the long-term capital gain, you have the capital gains tax rate that you are taxed at. And as I just mentioned, that rate is lower than your income tax rate. So you are incentivized to hold things or assets for longer than 1 year. And that will allow you to trigger the capital gains tax rate and not the short-term ordinary income tax rate, which is always higher based on the brackets that the IRS puts out. Then let's look at another example. So this one also takes place in a taxable brokerage account. Let's say you own a mutual fund in a brokerage account, okay? And let's say the fund manager sells assets very often in the short term. So he has a high turnover of assets within the mutual fund, okay? You will pay more in ordinary income tax, because whenever he makes a short-term capital gain within the mutual fund, a distribution typically goes to investors, and that is going to be taxable within that taxable brokerage account. Okay, that's why when you're talking about being tax efficient when it comes to capital gains, what you want to do in a lot of cases is hold low turnover mutual funds in taxable accounts because of this very fact. We don't want to be paying more ordinary income tax than we have to. And then let's say in this same example, let's say the fund manager were to not sell assets often, and when he does sell them, it's in the long term. Then you will pay less in taxes overall, and the taxes you do have are going to be capital gains taxes, not ordinary income taxes. And so it's beneficial for you to have like I just said, these lower turnover mutual funds in these taxable accounts, because that's going to allow you to be more efficient in the way that you're investing when it comes to taxes. And you don't want to pay more in taxes than you have to, and that's going to make you do so. And so that's just a couple of quick examples. But let's look at this third particular example that I have here. And this is about an IRA or an employer-sponsored retirement account. And that's where this particular example is going to take place. And you may say, well, why are these examples taking place in different places? Like the first two were in taxable account. Now we're talking about employer-sponsored plans. Why? Well, because taxable investment accounts are going to be where capital gains taxes occur. Because if you remember from yesterday's video, when you are investing in these tax advantage retirement accounts and employer sponsored plans and all these types of things that are either tax deferred or tax exempt, aka tax free, then you don't have to pay taxes on the gains. The money grows tax deferred or tax free. So you don't have to worry about capital gains. But in the taxable accounts, you have to worry about capital gains. Now that kind of gives away this next example, but I want to go ahead and walk through it anyway. So this takes place in an IRA or employer sponsored plan, like I said. And so let's say you own a stock, a bond, anything in an employer sponsored plan or an IRA. And let's say that after 18 months, you sell it. So you held it for more than a year. So capital gains tax rate? No. You're going to pay no taxes because this is either tax deferred or tax free. And so you pay no taxes when you make a gain in an IRA or a 401k or a 403b or anything like that. Now, what about this though? let's say you hold it for 6 months, then sell. Does that mean you pay your ordinary income tax rate like with the taxable account? No, again, no taxes, okay? Because all the growth you make in these accounts are either tax deferred or tax free. And so that's a particular advantage that you do find in those tax advantaged accounts that we didn't cover much yesterday because I didn't want to spoil today's video. But what you find is that you can take advantage of selling more in the short term within IRAs and 401ks.